Ken Rosenberg. I manage the international banking group at Western Alliance Bank. In the Bay Area, you would know us as Bridge Bank. We serve the technology and manufacturing companies in the market here in California as well as Arizona and Nevada. Our international banking group is headquartered here in San Jose, California, and we provide the traditional letter of credit and collections type of trade finance, as well as we have a very substantial foreign exchange trading activity, and we also are a delegated authority lender under the Ex-Im Bank Working Capital Guarantee Program. We'll talk a bit about each of those as I go through the discussion today. What I want to do today is talk with you about how to get paid for a foreign sale and the considerations that you need to put into your pro forma invoices, contracts, or negotiating the sale to receive the purchase order. You really need to have three things in there as you are negotiating that sale. The first one is the payment method and terms of how you're going to get paid. We'll talk about that in quite a bit of detail. The second is what's known as Incoterms. That's really the terms of trade and has to do with who pays for what and when does title transfer. And third is the pricing considerations as to what currency should you use? Should you use the buyer's currency or should you use the US dollar? We need to think about that in terms of what the risk might be in being paid in a foreign currency. The first thing I really want to go through with you is really the methods of payment. And there's a chart that I have prepared that I will take you through as to how you would be paid or what those terms of payment and methods of payment are. So to begin with, everyone wants to do cash in advance. But obviously that puts the buyer at risk because they're paying you cash before you performed in any manner of delivering the product. So as you look at the chart that I've laid out here, you'll see we go in sequence from cash in advance through letter of credit and collection type of transactions back to the cash from the standpoint of the buyer. So we'll think about it as in terms of you as the exporter. And the first thing that you look at, the old traditional letter of credit, and what's called a site letter of credit, means that you're going to be paid when the foreign bank that issued that letter of credit receives those documents, examines them, and confirms that they are in conformance. And we'll talk in a lot of detail about how that happens in a letter of credit transaction. But from the exporter standpoint, that's a very low risk as long as they are able to perform and deliver the product and deliver the proper documentation. And from the buyer's standpoint, that's a fairly low risk. It's a moderate risk type of transaction because they are only going to be paying upon your delivering evidence that you've delivered those goods. And I say we'll discuss that in detail. Site letter of credit being one. The second iteration of that is the what's called a usance letter of credit, where you agree to be paid in 30, 60, 90 days after some event, usually the bill of lading date, it might be invoice date, but some date that you have agreed with the buyer that that's the date that they're going to make that payment. That's built into the letter of credit terms, and the buyer actually signs a draft saying they're going to pay on a given date. So again, that's a very safe method of shipping and paying from the standpoint of the seller, and it is very comfortable for the buyer. If you are dealing with a customer that is very experienced with you and has become comfortable with working with you, you can go to what's called documentary collections. Same set of documents are sent, but those documents are then sent through the banking system. Your bank delivers the documents to the buyer's bank, and they collect the payment from the buyer and release the title documents to them at that time. So you're assured that they don't get the goods until they've been paid for, and then you receive the payment through the banking system. And again, that can be done either at site or under a USINS or 30, 60, 90-day terms. Then you get down to the last thing that's on this chart is the open account from the standpoint of the seller. That's the highest risk transaction you can have, but it does eventually that is the way you will find yourself selling to most foreign buyers in the developed countries. In much of Asia and some of the less developed countries, you may find that letter of credit is preferred. They may wish to provide pay in letter of credit as much as you have a need to be paid in letter of credit. So those are the real methods of payment that need to be considered when you start negotiating that sale with your foreign customer. What I'd like to do now is to go through the details of a commercial letter of credit. You need to understand that when I'm talking about the documents and materials in a letter of credit, that these apply to every sale you make. Whatever the method of payment might be, you're still going to have to deliver those same documents that I'm going to be talking about as the documents required under a letter of credit. So let me explain. A letter of credit is a method of payment by which the bank substitutes their credit quality for yours. So the bank is promising to pay upon the delivery of specific documents that are named in that letter of credit. Generally, there's going to be 4 parties in that transaction. There's going to be you as the seller. There's going to be the advising bank that is going to be advising you that the letter of credit has been received. There's going to be the issuing bank, which is the bank of your buyer, who is issuing that letter of credit to you. And then there's going to be your buyer, who is the applicant. In certain circumstances where there may be a risk in terms of country risk, or where it's a buyer you really don't know or a bank you really don't know, you may want to ask for a confirmation, and that'll add a 5th party, which is the confirming bank. But basically, you've got those 4 parties, the buyer, the buyer's bank, which issues the letter of credit, your bank that's going to advise you on the letter of credit, and you as the exporter. Again, as I mentioned earlier, there are payment terms. You can either be paid at site, and I want to make clear when we say site, that really means the documents have been delivered to the buyer's bank, and they have had an opportunity to examine those documents to make sure that they do in fact comply with the letter of credit. That means they get 5 days to review that. So when it says site, don't think that means I'll get paid today. There's going to be examination, and then the funds will be wired. USINS, as I said, it can be 30, 60, 90, sometimes 180 or more, whatever you and your buyer agree upon as the terms under which they will pay. What happens under a letter of credit is that the buyer signs a draft promising to make that payment. That is an enforceable document. under international law. And so they're really obligated to make that payment, and the bank is the one that actually signs the draft and agrees to make the payment. So you are still looking at the risk of the bank of your buyer, not the buyer risk. Shipping terms, I'm going to talk in some detail about that as we go a little further on. But the shipping terms really, we call Incoterms, determine who pays for what and when does the risk of ownership transfer from one party to the other. So what you want to do when you're working with the letter of credit requirements is work with a bank and that can help you understand how this is done and that has letter of credit capabilities in your local market that you can work with them to understand how to get these things done. The benefits really are the exporter is assured of payment as long as they can deliver the documents as required. And from the importer's standpoint, they don't have to pay until those goods have actually been delivered as agreed and the documents have been delivered. So that's really how the letter of credit operates. I'm going to take you through one a slide here, and this is a animated slide that I'd like you to take a look at, and I'll just go quickly through how the transaction flows as you conduct a letter of credit transaction. So to begin with, you have a buyer and seller who negotiate the contract. Once that contract is negotiated, the buyer applies for a letter of credit to their bank. That's the issuing bank, and the issuing bank then sends that letter of credit to your bank as the advising bank, who in turn advises you that they've received that. The act of advising the letter of credit is actually validating that what you've received is in fact a legitimate letter of credit from a bank that they know. Once you have that letter of credit in hand and you can confirm for yourself that you can perform, and we'll talk about that in a bit, you then arrange the shipment, usually through a freight forwarder, and may have your own freight department, but you're going to ship that, arrange to ship that shipment and deliver the documents, or arrange for receiving the documents that you need to deliver. Once the shipment takes place, you will then collect all the documents and deliver those documents back to your bank, the advising bank, who in turn will examine those documents if you wish for them to, and this is a choice you have. Normally you would have the advising bank examine those documents to make sure that they are in conformity with the letter of credit as a bank looks at it. And that way you can be reasonably assured that those documents will be accepted by the issuing bank. Once they have reviewed those, given you an opportunity to make corrections if necessary, then they'll send those documents to the issuing bank, who in turn will examine them. And if they are in conformity, they simply either debit the account of the buyer or have them agree to payment at a future date, and they will then transfer the funds back to the advising bank, who in turn will pay you. So if you follow that animated slide through, you see the step-by-step as to how a letter of credit transaction takes place. So from that, let's talk about the best practices for using a letter of credit. And I remind you again, when I'm talking about the letter of credit, we're really talking about the documentation and processes that are necessary for any export sale. The fact that a bank has promised to pay you upon delivery of those documents takes away the credit risk, but you still have to deliver that same set of documents, generally driven by customs and by UCC requirements. So what I recommend to everyone is that the exporters send to their buyer what I think every bank will provide you, and that is a letter of instructions to the buyer to take to their bank as to how that letter of credit needs to be issued. So ask them to then issue, or prepare, I should say, a draft of that letter of credit. And you want that to be the bank's draft of the letter of credit, not the application that your buyer took to the bank. You really want the draft. And once they've prepared that and delivered that to you, you can take a look at that to determine if, in fact, you can deliver the documents. And those documents are generally going to be, number one, they're going to be a draft, that's the demand for payment. There's going to be your invoice for the amount, detailing the amount of that payment, and there's going to be a bill of lading or some other evidence of performance. And that is the document that transfers the title and allows the buyer to take control of those. Along with that, you're very likely to be required to provide a certificate of origin. Almost universally, a certificate of origin is required. Sometimes if you're shipping to China, for example, you end up required to provide a certificate that no wood was used in the packaging, or that if there was wood used in the packaging, it's been fumigated. So there's a number of different documents that you'll find that may be required by local customs in the country that you're shipping to. You want to be sure that you can produce or obtain those documents. So that's the part you want to look at, that draft letter of credit, and say, how am I going to get each of these documents? Once you know that you can do that, then you can inform the buyer that you're prepared for them to issue the letter of credit. They'll go back to their bank, have the letter of credit issued, and advised to your bank through what's called SWIFT. And that's where, as I said before, your bank advises you that you've received a valid letter of credit against which you can ship. So that's the process for the letter of credit. Upon advice of that letter of credit from the advising bank, you're getting those documents together and delivering them to the bank in order to get paid. So that's really the process for going through a letter of credit, or, as I said, any other export transaction. All of it's the same except delivering the documents to the bank. You may send those documents directly to the buyer, and they'll take them through customs, and that's the open account sale. But the same set of documents are required. So that's basically the letter of credit transaction. One of the things I mentioned is that the terms of trade, Incoterms, are included in the letter of credit language. Will say what are the Incoterms that are used. The reason Incoterms are so important is they establish the obligations of the seller and the obligations of the buyer, and when risk transfers from one party to the other. So there's a long list of things. That some of the keys are licenses, who's responsible for transportation, who's responsible for the insurance for the cargo, who's responsible for the delivery, how is that delivery going to take place. All of that is included in the Incoterms that you select. And you should become familiar with Incoterms 2010, as those will describe who pays for what and when. Common examples of the Incoterms, one of them that everyone wants when they do their first export shipment is ex works. It means that the buyer picks up the goods at your dock or at your plant. Problem with that is they may decide not to pick it up. Or they may find that because they're sitting in a foreign country trying to arrange to get goods picked up at your plant, it becomes a problem for them just logistically. So I discourage ex-works shipments because you are not in control of when and how that shipment is going to be made. Another one that people like is free on board, FOB, meaning that the goods have been delivered on board the vessel, and then that is the responsibility of the buyer. So in that case, the risk transfers when those goods went over the rail on board the ship. And at that time, you have transferred the risk to the buyer. However, the buyer has to book the freight and send the vessel to pick up the goods. And if they don't do that, you're never going to finish the sale. So think about those in terms of the Incoterms. Think about how you can perform and make sure the transaction is completed. You go all the way down to what's called DDP, delivered duty paid, where you would have to have an actual presence in the foreign country in order for you to actually receive and pay the duty on those goods before you deliver them to the buyer. But you go all the way then from what I said earlier, the ex-works transaction, all the way through to delivered duty paid in country and ready for the goods to be used. I'd say, why is that important? It controls the time of delivery. It controls how the documents are produced and determines that you can get those documents. And finally, the transfer of risk, which is critical from the standpoint of when does that title transfer and the risk go to the buyer. So that's basically the how to get paid. And now I'd like to talk a little bit about how to finance those transactions so that you can produce the goods and deliver them and keep your working and provide the working capital you need. And also how you may be able to use financing as a tool to sell to your buyer. So the first thing I'd like to talk about is Ex-Im Bank's Working Capital Guarantee Program. Ex-Im Bank is short for Export-Import Bank of the United States. It's a government agency that provides guarantees to banks for the banks to make loans to exporters of U.S. manufactured or produced goods. So we as Western Alliance Bank, as I think I mentioned at the beginning, we have a delegated authority at $7.5 million that we can approve a line of credit up to $7.5 million on our own underwriting and determination that it meets the requirements of Export-Import Bank. What we get is a 90% guarantee against the risk of loss in those lines of credit. And that means from our standpoint that we get a guarantee even if you fail to perform and pay us when you get paid, we can get paid by Ex-Im Bank. What the Ex-Im Bank program allows us to do is to lend to you at very favorable advance rates. We can lend to you at 75% of the value of the inventory and 90% of the value of the accounts receivable, which is very favorable when you consider that most banks are reluctant to lend against inventory to begin with, and if they do, it'll be around 50% of the value of that inventory, and from a receivable standpoint, around 80% of the value of the receivables. So it gives us an opportunity to really promote the export of U.S. product. There's some restrictions, some requirements on that. Over 50% of the value of the product must be U.S. sourced or manufactured. There are no military products or buyers permitted. So we don't do guns and bullets under the Ex-Im Bank program. And we cannot sell to, even if it's clothing, for example, cannot sell to a foreign buyer. There may be a requirement to consider whether or not there is a negative economic impact, and what that really means is, are you selling capital goods to a foreign customer who in turn is going to produce product and ship them to the U.S. and in competition with a U.S. manufacturer? That generally doesn't really pertain, but we always have to take a look at that. There is a country limitation schedule that's readily available to you on Ex-Im Bank's website, and they will tell you some countries that were prohibited from financing sales to. Cuba comes to mind, or Iran, or obvious. But there are some countries where we are not able to provide financing for sales to those countries. Semi-annual audits are required, so that there is a significant audit requirement. And the reason we centralize the administration of these programs is that there's strict compliance with the Ex-Im Bank rules that we must follow in order to make sure that our guarantee remains valid. And so we centralize the administration that runs out of our international banking group, and we are then able to be sure that if something should happen to go wrong, we do have a valid guarantee in place. So that's the working capital guarantee program. I should mention it has two flavors. The first one is simply the revolving credit, where you're selling to foreign buyers on a repeated basis, you're manufacturing product, delivering to them, invoicing and being paid. The other flavor is that you may have a single sale of a significant component, or you may be manufacturing capital goods that you have a $2, $3, $5 million, $10 million sale, and you need to produce the goods to sell. Under that program, you actually can start borrowing against the inventory, even though you may have no receivable. And you can start borrowing against that inventory to build up the shipment, and then ship it and convert it to an accounts receivable financing methodology. So a little different than the revolving sale. The revolving type of transaction, we expect the predominant amount of that to be under the AR, accounts receivable portion of the line, and a portion under the inventory. And that where you have a single sale, you can use 100% of it under the inventory at the beginning. So just adds a little extra value. Last thing I want to talk about is the ability to finance your foreign sale for your buyer. And this really applies to, again, capital goods. If you're manufacturing a plant and equipment for a particular buyer, you can apply to Ex-Im Bank for a guarantee that will allow you to offer financing of 2 to 7 years to your foreign buyer. They must make a 15% down payment. The 85% that remains, Ex-Im Bank provides 100% guarantee to the financing bank. And so we, as a lender, will actually purchase drafts from you, purchase notes from you that have been signed by the foreign buyer. And then we are financing that transaction, and we get paid over the life of that transaction. Now, the way that operates, obviously, is you work together with us or your bank to arrange that financing, to structure it. We underwrite the risk of the foreign buyer and deliver that to AMBank, who reviews that and determines if, in fact, they will provide the guarantee. Once you know that, we can then offer the financing to the foreign buyer and arrange for them to pay over a period of time. So it's a good tool for those of you who might be manufacturing capital goods and have buyers who would like longer term financing rather than just paying you on a invoice basis. So those are the kinds of things that you really need to consider when you're looking at doing an export transaction. Go back to, as I said in the beginning, what are the methods of payment? How are you going to actually going to get paid? What are the different terms of payment? And then consider the Incoterms. Be sure you really know how you're going to be able to ship and when that risk transfers. And finally, how do we finance those transactions? In our case, using the Export-Import Bank guarantees, which are very valuable to us. So with that, if you have any questions, like to follow up with it, my contact information will be available at the end of this presentation, and thank you very much.